If I can leave you with one chart today, I'd like it to be this chart, which really illustrates what's happened in China over the past few years. The breaking point, the turnaround for China occurs in 2018. In 2018, this is when the US government says nobody is allowed to sell semiconductors to China anymore. And this was a cold shower for the Chinese leadership. This is when they thought it's not a trade war, it's a tech war. The US is out to curtail our growth. It's semiconductors. Tomorrow, it could be car parts, it could be chemicals, it could be any number of things. We have no choice but to become self-sufficient in every single industrial vertical. Therefore, we tell our banks normal loans to real estate. What you're looking at, the red line, is loans to real estate. Instead, put all your money in industry. The banks were told this, and when the banks are told something, they typically do it, if you don't want to find yourself in jail for one reason or another. And so you see this massive shift in the Chinese economy. Now, what the entire Western world focuses on is this line right here, a red line that shows a massive real estate bust. And I think there's many reasons we focus on this, not least of which that the Western world went through a real estate bust in 2008. And so we thought, oh, we went through it in 2008, they're going through it today. I've seen this movie before. I know how this ends. Banks are going to implode, etc. Banks did not implode. In fact, last year, Chinese banks were the best performing banking sector in the world. Banks did not implode because they were lending somewhere else. And now we wake up 5 years later, 6 years later, 7 years later, and we wake up to all of a sudden a new reality where China is the biggest car exporter in the world, the biggest industrial robot exporter. China is producing better trains. China can produce nuclear power plants at half the cost that we can in the Western world. Pick any industry that you care to think of, and the West has been leapfrogged. Literally any industry. And even fighter planes now. Fighter planes is one of the hardest thing to produce. And here's the fun thing. While we're all focusing on the red line and talking all day about whether Shanghai real estate prices were going to go down another 10% or not, something that impacts absolutely nobody's life in here. This was happening. Now this impacts everybody's life and everybody's portfolio. Because if China is about to take over the global car market, this is very problematic for Germany, much more so than the Shanghai real estate price. This is much more problematic for Sweden if China takes over the industrial robots market, and so on and so forth. And it is happening. For the past 3 years, every year, China's put in more industrial robots than the rest of the world combined. China is changing the auto market as we speak. Oops, sorry. This is so far not out. The BYD Chin that you see here is a revolutionary car. It's a hybrid car that goes 2,300 kilometers on one tank of gas. You can drive from London to Rome and not have to fill up again. This is a car that potentially destroys the EV industry because, you get to such high gas mileage that it's like, well, even if I really worry about my carbon footprint, it's now so low. Now, how do we get there? BYD is a terrific example. That BYD Chin, when it first started, the BYD Chin is like the Toyota Corolla. When it first started, it cost 220,000 in 2008, 220,000 renminbi. And BYD workers, there were about 100,000 BYD workers, and they were paid 11 renminbi an hour. Today, there's over 700,000 BYD workers. They get paid 6 times as much, 68 renminbi an hour. And the BYD Chin, which is a much, much better car, none of you would have wanted to buy this car. Everyone in this room wants to buy that car. The BYD Chin, that goes 2,300 kilometers, sells for 100,000 renminbi, 14,000 US dollars. This is a revolutionary car. And the reason you have record car sales in China is that it now costs less than 10 months for a BYD worker to buy this car. And it's cars, and it's that deflation you find absolutely everywhere. The price gap that has now unfolded between China and the US is just enormous, and the rest of the world. Come and spend your holiday in China. You can stay at world-class hotels for $200 a night. So I bring you back to this important chart, and I know I got to take questions, so I'm wrapping it up.
So we can just keep on going.
I'll wrap it up. I'll bring you back to this all-important chart, the trade surplus, because usually what should happen is that a country running massive trade surplus sees capital inflows. As the capital come in, the exchange rate goes up, and the guys making the money turn around and they buy themselves nicer homes, or they build new factories because they're so productive, or they buy local assets. And so you get a stronger exchange rate and stronger asset prices. With that, you get stronger domestic consumption. And with the stronger domestic consumption, the trade surplus abates. This is how nature heals itself. This is your typical cycle. But what is happening in China? In China, you're seeing massive surpluses, and the people earning these surpluses, very often earning these dollars, their confidence has been absolutely crushed. It's been crushed both by the decisions of their own government, the crackdown on property, the crackdown on tech, the crackdown on education, and by all the trade uncertainty. Today in China, if you're running a factory, maybe you're super productive and you're making all these profits abroad, but you keep being told, oh, there's going to be 60% tariffs in Europe. Oh, there's going to be 80% tariffs in the US. So you don't build another factory. Just said, you know what? I'm just going to sit on my cash. Entrepreneurs typically anywhere in the world just want to know the rules of the game and then they get on with it. In China, they keep being threatened with big rule changes. So the natural decision is to say, I'm either going to keep my money at the bank, and because there's no demand for bank loans, Chinese bond yields fall to new lows, or they buy gold, and gold imports in China have been at record highs, and gold is in a bull market, or they decide to keep US dollar cash offshore. And that brings me, and perhaps I'll conclude with that because I know we got to take questions, but that brings me to perhaps what is the single most important question that nobody is asking themselves. If you look at the amount of US dollar cash deposited in Hong Kong banks, it's gone up by 220 billion over the past 18 months. Billion with a B. That's a lot of money. Like $220 billion cash increase. What you're now seeing in Hong Kong is not that dissimilar, except on a bigger scale, to what you saw in Europe in the 1960s. European currencies were cheap. Europe ran trade surpluses with the US. They started to be too many dollars in Europe, and these dollars found their ways into London banks, which ended up creating the euro-dollar market, where that essentially saw dollars being lent outside of the US, completely out of the control of US authorities. The US Treasury, the Fed, had no idea what was going on. A multiplier effect on the dollar that was occurring outside of the US. Now let's ask ourselves this. Just as you had a euro-dollar market created in the 60s in London that would end up triggering massive inflation in the US in the 70s, could we be seeing right now the same thing, not in a euro-dollar market, but in an Asia dollar market? With lending reaccelerating, both US dollar lending outside of the US through Hong Kong as a financial center, either through the US dollar or perhaps through the Hong Kong dollar. Think of India. India wants to buy oil from Russia. What's the simplest way to do it now? Borrow, there's 6 different Indian banking licenses in Hong Kong. Borrow Hong Kong dollar in Hong Kong, give them to Russia to buy the oil, pay for the oil in Hong Kong dollars. Then Russia can use those Hong Kong dollars to buy Chinese cars. And you end up with a multiplier effect that nobody is thinking about. So when you think of what is happening in the markets, perhaps this collapse in Chinese confidence, this $1 trillion a year on which China is sitting, that explains the soaring gold, that explains the collapse in Chinese yields, that explains the strong dollar, that explains the outperformance of the US, that explains the trade surplus. Doesn't so much explain the rising UST yields. But the reason, and I'll finish with this, the reason I think this is important is that while consumer confidence has been absolutely crushed in China for the past 5 years, I think there's a lot of reasons to think that this could change in the coming year. It could change because first you have a US Treasury Secretary, Scott Bessent, who is very keen to do a deal with China. He's come out many times. He's come out and he was asked, look, it sounds like you want a new Plaza Accord. He said you must mean a new Mar-a-Lago Accord, highlighting that he's even got a name for what he wants. And so you have a Treasury Secretary that wants a deal with China. And I'll just highlight that since he was reelected, President Trump has bashed Europe, he's bashed Canada, he's bashed Mexico, he's bashed Panama, and he invited Xi Jinping to his inauguration. And there's been no China bashing since he got elected. So I think there's big appetite. There's big appetite for a deal. And then when China itself, you have a government that has very clearly signaled its desire for reaccelerating growth. And basically every month that comes by, you get new stimulus measures. And that at some point, if these stimulus measures start getting traction, that means you have a lot of money on the sideline, money that perhaps to other assets, whether you're Mag 7 in the US, whether gold, that could be redeployed pretty quickly in domestic assets. So I'll leave you with this. Today in China, again, economic data bottoming, fiscal stimulus, monetary policy stimulus, interest rates at record lows, record level of cash on the bank, China now outperforming every market, and nobody cares. Thank you very much.
What do you guys think? Do you have anything to add on top of this conversation? Please leave your comment below. We would love to hear from you.
Thank you for making it this far. If you like this video, you might want to share it with a like-minded friend. Thank you, and as always, stay blessed.